Good afternoon. My name is Chuck Morton, and on behalf of Venable, AccuVal, and Newport Board Group, I'd like to welcome you to today's webinar entitled Best Practices for Effective Fund Life Cycle Management, Maintaining Alignment in Mature Funds for GPs and LPs. We have many folks who have joined us. I want to first extend our gratitude and welcome to each of you. Please be advised that this webinar will be recorded and all of the phone lines have been muted. In order to ask questions during the program, please use the chat box on your computer screen. This webinar will be posted to the Venable website as well as, I think, the Newport and AccuVal websites as well for future viewing after the program. Today we are joined by Michael Manley, a partner at Venable, as well as Peter Rugg, a managing director at the Newport Board Group, and Cameron Cook, a managing director of business valuation at AccuVal. We're going to try to contextualize the life cycle of a fund. There we go. From formation and structuring through raising capital, sourcing deal flow, managing portfolio companies, and exiting investments, all with an eye towards trying to maximize value to the investors. The landscape, as all of you know, is changing, and it's changing dramatically. There are a record number of funds in the market. According to Preqin, nearly 2,200 funds are in the market right now. LP due diligence is increasing. There are lots of different structures now to try to achieve the interest of the LPs. And one of the real challenges is that 85% of LPs are not planning to re-up with GPs whose last two funds they backed. So in this rapidly maturing landscape, we have a number of issues that really can challenge the GPs and the LPs, particularly the alignment between those. Peter, obviously there are some things that change over time, and I'm curious to hear your thoughts about the way in which the time horizon of funds can impact alignment.
Thanks, Chuck. This chart is a graphic representation of how alignment may slip over time. During the beginning of the investment in the early years, the chart indicates about 100% in alignment. Clearly, no investor is going to line himself up and plunk his money down with a GP who he doesn't feel has a credible, well thought out opportunity to make some money for both of them. As time goes on and the life of the fund is sliding across the x-axis, things can bump up and down, but generally they might bump down more than up. It depends really on performance, and performance is a critical key here. But if some early exits can provide nice returns, a kind of unexpectedly early returns to the LPs, then they're going to be pretty happy on the alignment scale. As the life of the fund extends even further, they're going to be expecting to be paid out along about year 10, and if they're not, they start to become impatient LPs. A lot of funds in extension are finding that there's quite a significant amount of lack of alignment, and yet we have a client who is in their 15th year with a fund, and by year 10, 2.7 times the original investor's money was returned, and there was still some stuff being matured. So for the last 5 years, those have been sort of like nice gravy dividends, and there's really good alignment. All of those LPs have invested in several subsequent funds with that particular GP. So the reverse of this chart.
And Michael, are there times when you can anticipate this inevitable evolution of interest between the LPs and the GPs? And in fact, at the moment of inception of the funds, are there things you can do when it comes to structuring to anticipate and try to maintain alignment?
Thanks, Chuck. I think it makes sense to put the right amount of effort up front in terms of your planning. good planning, thoughtful process up front hopefully allows you to manage through the life cycle effectively. That can come or manifest itself in the structure of the fund, making sure that you've properly identified, for example, where your investors are coming from. Are they onshore or offshore? And whether there are tax characteristics or regulatory characteristics of the investors that may inform your structure. In terms of your agreements, clearly whether it's a limited partnership agreement or LLC agreement, this is where the investors are going to see their rights and obligations, and clear understanding of what those are also helps as you work your way through the life cycle. At a very high level, the model should provide, on the one hand, sufficient cash flow for operations for the GP, but also provide incentives for generating investor returns. For example, the waterfall provision is an important element of that, and that, for the audience benefit, is the order in which distributions are made to the investors, the LPs and the GPs. Similarly, the hurdle rate, which is essentially a preferred return on capital contributions, is an important element of aligning interests so that both the GP is incentivized to do a good job and make good returns for both themselves and investors. Disclosing the structure of the fund and these economic provisions helps avoid, I would say, misalignment throughout the life cycle. And there are other elements to those structuring and agreement provisions that can be very helpful. Similarly, a robust compliance and reporting program. That's something that many of the LPs want to know very much about, what compliance procedures you have in place, and what reporting and information rights they have in terms of receiving regular information from the firm. One element of that, which I will invite Cameron to comment on, are valuation policies and procedures. So, Cameron, let me turn it over to you.
Yeah, thank you. Certainly, the valuation policies are very important, and they certainly do need to be very strong, clear, and transparent, but specifically they should be stating how often the investments are valued. If it's a hard-to-value entity, they should be valued in such a manner that is reasonably beneficial to the investor, to the LP. Some people think that's every year. Some funds think it's every 6 months. Some think it's every month or every quarter. So certainly stating how often the investments are to be valued is important, and tell the limited partner how that's going to be occurring. So it's also important to determine who is going to be valuing those investments. Is it going to be an inside party, or is it going to be an independent third party that is going to be doing the valuation? So all those things have to be detailed out in a valuation policy and such. Certainly to be a little bit more pointed, the valuation analysis should be available to the LPs upon request and for investor reviews or audits. And that means that, hey, look, if you're going to be providing a certain valuation policy and saying this is what you're going to do, then the investors, the LPs, should be able to rely on that policy, and they should be able to set up their assurance program or their review program to verify that, in fact, that is the policy that's being followed. For example, we value certain hard-to-value assets for private equity groups, and their LPs will actually call us once in a while to say, gee, the managing partner indicated that you valued these interests in privately held companies. Did you do that? Please confirm, all that kind of thing. So indeed, I guess one of the tips down below here is that the LPs should be reading the valuation policies, and they should be building their review program or their assurance program around that policy to verify that the general partners are in fact doing what they say they're going to be doing.
Cameron, that's an excellent point. And Michael, I know before you joined Venable as a partner, you had an opportunity to work as general counsel for a fund, and in particular a fund that got to a pretty late stage in its development. As that fund matured, were there practical lessons that you learned that helped to reinforce these points?
Yeah, thanks, Chuck. I think one of the first and foremost lessons learned was regular open communication with the investors, making sure that they understood where the fund was in its life cycle, to the extent there were opportunities or challenges that needed to be addressed, that they were communicated to the LPs so that they weren't surprised by decisions or even in some cases performance as the reports were distributed. So that would be one of the main lessons I think that you could take away from that.
Yeah, I know that at least some of the folks who registered are LPs, so I think they would probably echo that encouragement for regular, candid, and transparent communication. Peter, I'm sorry, Cameron, were you going to?
Yeah, and Chuck, something I would mention here is that for those LPs and general partners as well, for that matter, certainly there are industry-recognized guides that can help the party get expectations as to what should be done for reporting and valuation policies and such. And the International Private Equity and Venture Capital Valuation Guidelines, the IPEV guidelines, as I say, can be used as a guide when valuing investments. So, looking at that document, looking at those industry standards, so to speak, can help a LP get an expectation of how the valuation would be performed or should be performed. And sort of on a related side is the investor reporting guidelines, the IRG, that's also put out by the IPEV board. They can be used as a reporting and disclosure policy guide. So those are some areas that LPs can go to build expectations as to what the fund policy should look like, perhaps.
Sure. Peter, your background includes a long stint at J.P. Morgan, including very senior roles there and serving on very many public and private boards. I'm sure that experience has given you some insight into the ways in which raising capital for these funds can influence alignment. Curious to hear your thoughts about that.
Thanks, Chuck. I think the most important thing for alignment is something we've discussed over the last two slides, transparency. But when raising capital, one of the key things that an LP looks for and a GP needs to articulate is something that differentiates them from the rest of the pack. It may be the investment model. It may be the source of the deal flow. It may be the track record. And even a fund that gets to their sixth or seventh fund that's got a very sound and long-standing model that's proven its capability to earn money year after year, they need to let the LPs know when they're raising the next fund that they're not going to deviate from that successful strategy where they've built a team and a track record. So articulating that strategy and then sticking to it becomes very important for both institutional and individual investors. Along the way, it may be useful to bring in some senior or industry advisors, particularly any industry specialized fund needs to have some credible people among the GP managers who are known for having a background and experience in that particular area and know how to invest in that area and make money.
What we're beginning to see is an increasing level of industry sector differentiation. And consistent with that, funds that have very specific investment theses around specific industry sectors. And that is, in many instances, really based upon having these sort of senior advisors that you're talking about. And without them, our experience is that it has become very, very difficult for funds to distinguish themselves in the fundraising world. And a fund's ability to both clearly articulate that thesis and then clearly report on that thesis is important. I know that one of the folks who registered to attend today has a business that helps to provide back office support for funds, middle market oriented funds, which highlights, in my mind at least, the importance for all funds to have very sophisticated, thoughtful reporting mechanisms in place, in part, as Cameron talked about, with valuation issues, but also just managing the fund. Michael, in your past experience when you were actually in-house working on these things, how were those policies communicated to investors, and how were you certain that the fund was adhering to them in a disciplined way?
Well, it goes back to things that we've already talked about in your offering documents, clear disclosure, whether it's in your private placement memorandum or in your limited partnership agreement. Those documents clearly articulate your strategy, the policies, and the information that you're going to provide. One of the issues that did come up periodically when you're in the raising capital mode is in the early stages you may have a large investor who becomes the equivalent of an anchor tenant for your fund, and they're maybe taking on more risk and might ask for some special protections, and those might get reflected in what's known as a side letter. Side letters can address individual circumstances of each investor, and it may seek protections related to economics, to regulatory matters, to tax characteristics, and even in some cases policy questions. And so in that case, there's something that the GP or the sponsor has to evaluate as they're bringing in more LPs, and whether or not there's anyone, for example, who is asked for what is not necessarily common, but it can happen frequently, especially if they're an early stage, a most favored nation clause. Now, the GP is frequently going to resist that because it makes it potentially harder to align interests over time throughout the life cycle. But there may be very good reasons for the LPs to ask for that type of protection, which I've mentioned. So that's something that when you're raising capital and launching, you want to keep in mind about what's your approach going to be with respect to side letters. And you may not always know until you are faced with someone who brings that tax characteristic to the table where you do feel, well, I do have to give them some protection here, and then figure out how you manage that going forward.
Can certainly create a lot of complexity if you've basically struck slightly different deals with some of your key investors, and trying to manage through that can make things more complicated. Sourcing deal flow obviously is an important consideration as well in a very competitive landscape, both fundraising and then most importantly execution. Peter, I'm curious how sourcing deal flow strategy has impacted fund performance in your experience.
Well, from the standpoint of alignment, this is part of the trend that we suggested as starting with the original structure of the fund documents, the raising of the capital, and then we get to deal flow. Articulating that strategy and sticking to the strategy, as the tip says, is very important to maintain alignment. As Chuck said, almost every successful fund has a differentiated philosophy for where and how they're going to find the right kind of investments for their talented pool of experts to work on and raise to create favorable returns. Whether it's a general fund that is focused on early stage in the venture area, or later stage venture or buyouts from existing companies, or whether it's a fund that's dedicated to a certain industry or a certain geography, a certain difference in the market. The issue is to find the right opportunities within the deal flow that can be generated around that opportunity to invest. Once one is beginning to look at things, it's particularly important for the general fund that's crossing many different industries, many different areas of business investment, to have the right help and information to properly do due diligence and evaluate an opportunity and to create an investment opportunity that's going to be successful. There's a lot of advisors available with specialty expertise in different industry niches. We have a lot on our team at the Newport Board Group who have done a significant amount of primary or preliminary deal evaluation and due diligence, and from there, with their specialized industry expertise, leading into the creation of a closing plan and a 100-day plan to implement a new investment and integrate it into the portfolio of a private equity investor. When these strategies are implemented effectively with very, very good industry knowledge, that gets these new investments off to a good start so that they can grow and provide the returns that everybody's seeking.
Obviously, one of the ways in which funds are able to create returns is through the effective use of leverage to enhance cash-on-cash returns. And there are lots of variables that go into the ability to effectively access the debt markets. Cameron, I'm curious to hear about your experience of how valuations in the context of this whole sourcing exercise impacts a fund's ability to get to the appropriate financing.
Certainly. Once a target is cited and on the hook, so to speak, the valuation of an acquisition target can influence funding by the banks, definitely. Independent valuations can give banks more confidence when lending. They know that the private equity group has done a lot of due diligence and they've done their own valuation work, but the banks like to see an independent party come in and give a different perspective or their perspective. And that being done by an outside independent professional appraiser can give the bank a lot more confidence, and indeed is required by most of the banking policies. The identification and evaluation of specific collateral that the target company has obviously is very important to getting good funding from the bank. The machinery, equipment, inventory, intangible assets can all help support funding. And the more funding you get, the more bank financing you get, the better return you're going to get on your equity. Usually the more bank funding in a deal, the better return you're going to get because you're going to be able to put in less of your equity and get a better return on it. So certainly we see that our involvement in the initial funding of an acquisition is very important to private equity groups.
One of the things that has become particularly attractive for funds over the past couple of years with the access to relatively inexpensive debt has been not just aggressive leverage going into deals, but occasionally recaps of deals where the funds would actually take some money off the table. I'm assuming that your comments apply with equal strength to those recap structures as well.
Yes, they do. And that is usually a midway through the life of a particular investment, for example, or something of that nature, when the private equity group feels confident enough that there's been enough value added, they will perhaps want to do some recapitalization, and they will have us come in, or actually usually it's the bank or someone else will have us come in and take a look at the value as it stands at that point of recapitalization.
That's certainly a strategy if there's an outside risk that you're going to get to year 15 in the fund. If you've been able to take enough cash off the table through recaps, that may help to maintain alignment longer than you would be able to keep everybody on the same page. Obviously, deal structure, Michael, impacts these things as well. What are some ways that deal structure can help to provide protection, particularly in the context of the acquisitions and the sourcing?
So as we've talked, funds are vary in terms of type and purpose. The LP's investment decision is going to be based in part on the fund's disclosed strategy and the related experience of the management team. So during the life cycle of the fund, the conditions, market conditions, business conditions may make it more difficult to source deals that are consistent with that fund strategy. And that's where misalignment can occur when investments are made that may be beyond the scope of the fund strategy or the management's experience. So when you're putting your deals together, it also includes the deal structure for the investments themselves, and whether you're investing and providing debt or equity or both. And it may turn on what type of protections have you built into those deal documents if a portfolio company for some reason doesn't perform and you need either to get out of the investment or maybe even take control over the investment. So it includes reps and warranties. It includes covenants, both positive and negative covenants. And it may extend even beyond to some ability to put back your investment to the company. So these are all tactics that need to be considered when you're putting your deal structure together so that you can manage the investments efficiently.
What role, if any, does rollover equity for targets, owners, or having trying to stack the deal with more contingent consideration for the sellers play in potentially trying to align the target's interest with the fund's interest and therefore the LP's interest back to the GPs?
I mean, it's an interesting question. I think every deal is different.
Sure.
And a lot of it has to do with the characteristics and the bargaining power and leverage that each party has when they're going into the deal. So I'd say it's hard to say that one size fits all there. I don't know if Peter or Cameron have any other ideas or thoughts in that regard.
I think there's almost as many alternatives as there is imagination.
I agree.
Yep. Well, that was pretty speedy accord among three people thinking about this from different perspectives. Of course, prompts a thought of moving on to the next slide. So again, contextualizing this, our view of this is that there is this circle of life cycle of the funds and also the investments. So clearly, for funds to thrive and succeed and be able to create the value that they've suggested to their LPs, they'll be able to create. Managing the portfolio companies is an essential component of that. And that requires discipline. And Cameron, let me throw it out to you in terms of the type of discipline and the ways in which thoughtful, proper management of these portfolio companies can help to maintain alignment.
Yeah, sure. I'll start this one off. Certainly, once investment in the portfolio company is made, the object is to grow the value of the company, and that's great. There's all sorts of different management policies that can be put in place, and probably Peter and the team will talk more about that. What's interesting to me, though, is being from the valuation side, that is that really there should be a planned strategy for managing the portfolio company, including a planned exit strategy. And you should manage towards that exit strategy. And you want to try to be consistent in managing towards that exit strategy. So, how the valuation folks get involved there is by doing regular valuations, regular periodic valuations, as we had talked about before, perhaps on a monthly basis, quarterly basis, every 6 months, maybe an annual. But that periodic valuation can help the limited partners and the managers of the entity, of the investment, to determine how they are going along that goal, how they are managing towards that goal. And they can give all the parties involved, limited partners and general partners, an idea of whether adjustments need to be made. The big thing there is the more you get to look at the performance and how they are doing, in relationship to the original plan, et cetera, the more often you do that, the less surprises you're going to have. What limited partners don't like is to all of a sudden find out that the investment that was originally made and they thought was going along nicely is all of a sudden, underwater and in the dirt, so to speak. So certainly you want to have that consistent, communication with the limited partners, and the independent valuations help everybody, all the stakeholders, including making sure that the party that's managing the investment is, in the ballpark, so to speak, that their perspective is not biased. An independent valuation provides great outside perspective on an investment and such. So, let's go on to a few other things here. What other, Chuck and Peter and Michael, what other aspects of managing the portfolio company do you see as critical in the process here?
Let me tee it up a little bit for Peter as well. So, Peter, I know that you at the Newport Board Group have assembled a stable of very experienced professionals who have built businesses and sold them and served on the boards of public companies and private companies, and that one of the things you provide as a service for your clients is that expert, seasoned professional with board-level experience to help. I'm assuming that the management of these portfolio companies is an essential part of what you guys are doing every day.
Chuck, that's certainly an essential part. Monthly reviews of financial performance, looking at key performance indicators, is part of the process that a board member needs to make sure is in place and working properly in order to track a company's progress. We've seen this work exceedingly well, and we've seen it work not so well from time to time. We recently were called into a situation where the debt investors, the mezzanine in a particular company, were finding broken covenants. And the equity investors thought, gee, this company's doing fine. It just wasn't, there was not even alignment between the equity investor and the mezzanine guys. And we had to help try to sort that out. It turned into an early exit for the equity and a recovery of some confidence in the company for the mezzanine. Another situation that is really interesting is you can't always write a plan that fits exactly what you expect to happen. We're working with a medical technology company that was developing a certain aspect of their technology, and as they developed it, it became relatively clear that this technology can provide a platform for about 4 or 5 other aspects of distribution and channels where it works. So the whole business model of this company now needs to be reevaluated, reconsidered as to how do they take advantage of that platform technology and push it not into one segment of the industry, but into 4 or 5 segments of the industry. So the senior advisors that we have, whether they're in healthcare or energy or technology or business services, get called in because most of them have been there, done that. They're CEOs who've finished their job. They want to sit on boards and give back a little bit of what they learned after 30 or 40 years of tough days and weeks. And on balance, what we find is that the financial advisors are really good at sorting out balance sheets and financial structures of companies, and our operating guys are really good at sorting out the P&L statement and getting more revenue at a better cash flow than others might be able to. So the senior advisors help with these portfolio companies and drive them towards that exit strategy.
What I often see is a portfolio company where the board consists of a handful of the sponsors' appointees, perhaps the exited entrepreneur who may have a rollover piece or not, maybe his or her buddy. But what those boards are often lacking is that independent third party without allegiance to either the sponsor or the founder, assuming that was the structure, and that sometimes both groups, notwithstanding all of their efforts to create alignment, can still be somewhat myopic about what they're doing.
It's true, and we've seen enough of it, and so have the GPs and the LPs seen enough of it, that I think there's a growing trend towards more portfolio companies with independent board members who are bringing that 50,000-foot look, a knowledge of best practices in industries or in finance and in general corporate management, and a sense of board governance and policy interpretation that can try to strengthen the entire management team.
And I see some larger funds, in addition to having a stable of highly talented operators who they may parachute into businesses, sometimes having this sort of stable of potential board members as well, which is an interesting trend I've observed over the last 5 or so years.
True. Many funds have a stable of people they've worked with, and when they've worked with people, they are very comfortable. They know their track record, and they're comfortable bringing them into a new situation.
And I agree. This is Cameron here, and one of the tips on this slide is consider adding an outside valuation professional to the fair value committee or the valuation committee. Well, it's not necessary to have them as a member, but they can certainly be there to assist in any questions that the governing committee has, to help them understand a different outside perspective, for example. And indeed, we've been on such boards or involved with such boards where, if they're looking at a particular investment, all the inside folks are very smart. Certainly they can do valuation work, but they really look to the outside to say, okay, where's our bias? What are we seeing that might be a little bit colored because of the glasses that we're viewing? What do you guys see? And I guess that's one of the main things is to, hey, that's what we're there for, is to provide them with an independent perspective and such.
So talking about questions, I do want to make sure that people understand that you have an ability through the ReadyTalk technology to submit questions. So as we go along, I'll do my best to incorporate questions that we may get. My experience with this and other presentations is that the more interactive they can be, notwithstanding the inherent awkwardness of the format, the better. But before turning to the next slide, Michael, I do want to make sure that we hear the ways in which the documentation of both the portfolio company and the fund itself can really create for a regular information reporting process.
Yeah, I think if we take it back to a high level, one thing that the entire process needs to consider is scalability. How quickly you can scale in terms of personnel, in terms of systems, and the other resources that you have will all help you maintain this alignment that we continue to talk about. That gets affected by the amount of money you raise and how quickly you do it, the number of investors that you have, and the number of companies that are in the portfolio, and all of those affect portfolio management. So with respect to reporting, it also is who are you surrounding yourself with? What administrator might you be using? Do you need to use a custodian, and who will that be? What prime brokers are you using from a trading perspective? And that, from that point, which is potentially more of a back office exercise, how are you connecting that information all the way through the process where you're managing the investment and then ultimately sharing the reporting, the performance reporting with your investors? So systems may also be a very important part and can be a competitive advantage for some firms if the systems allow them to report more quickly, more effectively, with more transparency. The documentation ultimately, at the end of the day, I think creates the framework for understanding what your obligations are and what your investments understanding is of what their investor is going to be doing with respect to managing it. How often should they be receiving reports? Are they going to be providing monthly reports or quarterly reports? And this gets discussed. And it may vary based on the size of the company and what their infrastructure is and what their systems are able to do. But if you have a standard of reporting that you consider necessary for your LPs, you want to make sure that that's aligned with the information you're getting from your portfolio companies. So that's all tied together.
Absolutely. And we do have a question from the member of the audience, which Peter, I'll direct to you, and that is, what percentage of funds have outside independent board members routinely in their deals? And I don't know that I've seen any academic research on that, but I'm curious to hear whether you have, and if not, whether you have some anecdotal insights.
I haven't seen any academic research on that point. Anecdotally, all we've seen is a trend towards a greater number of private equity firms who are looking for independent board members in their portfolio companies. Matter of fact, we know several private equity firms who want 2 independent board members sitting on each portfolio company's board. It really depends on how large these companies are, and the bigger funds with more larger portfolio companies are going to find a bigger need for this.
What I see as the PE industry continues to mature, and as funds with stellar track records are having a much easier time at fundraising, so they are naturally getting larger and larger and more sophisticated and more sophisticated and more sector focused, is that the larger funds almost routinely now, the larger, more sophisticated funds, have access to these independent board members. Now, how they get to them varies widely, and the level of independence from the fund may vary widely. After all, if you're serving as a board member on 3 or 4 of the fund portfolio companies, are you a fund employee, or it starts to get blurred at some point. But that as these funds mature, that access to such seasoned professionals who are described as independent board members for portfolio companies has become a distinguishing factor that these funds use, and they're using them in part because what they've discovered is that the returns are better if they have somebody with that sort of background.
And Chuck, I'll talk about the private equity group board itself, and the valuation committee for that matter. I guess I saw somewhere out there in the world of literature that approximately 1/4 of the private equity groups have their private investments, their investments in private companies, valued by an outside valuation professional. That's only 1/4. Now, the trend certainly is to go more to the outside. They want to have that assurance that there is no bias in the valuation. That's something that's definitely a trend. And for that matter, it can be an efficiency as well. When a private equity group investment board or fair value committee calls upon an outside supplier, outside provider of valuation services, if that party reviews that investment on a quarterly basis, annual basis, what have you, they get to know the market very well. And indeed, like any entity, private equity groups need to reduce their costs, keep the costs low. And perhaps like in AccuVal's case, that party that's doing the valuations for net asset value determination, i.e. that periodic reporting of what the investment is worth, they can also be doing other work. We, for example, have seen the full cycle from the valuation perspective. We will help the private equity group board determine what an appropriate investment is. We'll do that independent outside valuation to make sure that, they're not making a bad investment. And then we can be helping them provide some support for the financing. We'll get in there and do valuation work for the banks. And then after the deal is done, we can be doing purchase price allocation that is required on the company, the portfolio company side for their financial reporting. And then we come back up and work with the private equity groups to do their net asset value work and such. And finally, at the back end, we can help them decide, is this an appropriate price to be exiting at? Or in fact, if they want to have a fairness opinion done because, whatever reason, we can assist them with that as well. And all through that process, we get very familiar with those portfolio companies, and we get familiar with the management team that is running those portfolio companies, and we get familiar with the private equity group managers that are managing that investment. So we all make one big happy family, so to speak, reducing costs, but still providing good, solid, independent perspective in the investment process and management process.
And so,
Go ahead, Michael. Sure.
Maybe before we move on, one theme I think that everyone is touching on, it has to do with governance.
Yes.
And governance is at the fund level, and it's also at the portfolio company level. And many commentators are analyzing this in the context of do you need independent representation at the fund level? There are some vehicles that are governed by the Investment Company Act, for example, that require that you have a majority of those boards be independent. That hasn't been extrapolated into the private version of the fund necessarily, but it's something that some folks are considering. Similarly, in terms of the structure of management, should the chairman and the CEO be the same person? Even in focusing on the legal profession, should the general counsel and the CCO, the chief compliance officer, be the same person? And even to get more specific, if you have two different people, should the chief compliance officer actually report to the general counsel? These are all discussions that are occurring right now as we speak, and it's things that people should be at least contemplating as they move forward.
All of these represent opportunities in their nicest form to try to create alignment and maximize returns for investors. And those returns generally are created around exits. So you have a portfolio company, you create value in the portfolio company, you then sell it for the benefit of the LPs. Bad alignment obviously can jeopardize good exits, whether that be at the fund level or at the portfolio company level. Peter, why don't you share some of your thoughts about some of the issues that impact good exits, please?
Thanks, be happy to. If we start back for a second on deal flow and sourcing, I know a number of fund managers who end up closing only 3 or 4% of the total amount of deal flow that they source. And fortunately, I think the exit process, although there are lots and lots of different ways of going about it, I think it's slightly better than 3 or 4% in terms of successful exits. It needs to be for the industry to thrive. We think that exits should be considered not just as an end game, but it's all part of the process of getting returns back to the LPs and maintaining that level of alignment that we all like. So as we discussed earlier, a recap is a partial exit and an opportunity for an early distribution to the LPs. When there's been a significantly good event, or when various markets are particularly in love with a certain industry, it's a great time to think about doing a recap, taking some money off the table, getting that early exit, and pushing towards the end game when it's appropriate. Another type of exit that we are seeing more and more of is sale to another fund. There's, I think, about 46% of transactions last year were trades from one private equity investor to another, not an exit out of the industry, as it were. In those cases, it's because, A, it's harder and harder to find good new deals, but also many, many larger private equity portfolio companies are doing add-on investments, and many different funds focus on different stages of growth that's appropriate to the size and the capabilities of the managers in that fund.
Let's, if we could, Peter, use this as a jumping off point to think a little bit about the continuum that we talked about at the very beginning of our hour together, and the challenges with later stage funds. As the industry is maturing, and you have some funds that for whatever reason are struggling, either to raise another fund or they've just no longer have critical mass around the economic model of the fund. What are the challenges that can be found then, and what can fund managers do to be certain they finish strong, that they do what they've promised to do for their LPs, and navigate through that to get to a strong finish, even if that strong finish doesn't mean the next fund?
It's a good point. The strain that normally hits a GP in a mature fund when there isn't another fund on the horizon is a squeezing of management fees, and the fewer and fewer resources available to put capital into portfolio companies and drive them to an exit. And if an issue like bad economies in 2008 and 2009 end up driving or slowing down the drive to an exit because it just can't happen on the same time frame, all of a sudden there can be some crisis on the horizon. As general partners end up having to save some funds and reduce overhead, they may be laying off some of their good operating people or independent board members, and they may be looking to outsource a lot of those requirements for their portfolio companies to a professional advisory firm that may have good board members or deep domain expertise where their portfolio companies could be supported. In addition, a firm that's done a lot of that sort of advisory work and worked with many different private equity firms may be a catalyst in transferring a portfolio company from a mature fund to a younger fund that wants to invest in it and take advantage of the opportunity for the next 7 to 8 or 9 years. So the later stage funds are sometimes stymied by the failure of economics to be able to get to an exit, but they still have to do it sooner or later anyway. And the sooner they do it, the better they're going to retain alignment.
And Michael, in the midst of that challenge that Peter's just described, we have increasingly, at times, impatient LPs and a particularly aggressive and increasingly so regulatory environment with folks in Washington. What are some of the legal challenges that funds are facing when they get into this late stage and they've not yet raised another fund?
Yeah, let me just maybe echo something that Peter said in terms of the challenge and then address the specific question, which is, for example, if you're under pressure to liquidate early an investment where everyone knew up front that the investment was going to have a lifespan maybe of 5 to 7 years, and on top of that, it contemplated what I would call follow-on investments, where now because of the pressure from LPs and others, you're feeling pressure not to make the follow-on investment. It becomes a vicious cycle so that the success of that portfolio company is jeopardized because you can't support it. And that only further deteriorates perhaps the return or the performance. So that's a very interesting challenge. In terms of the regulatory environment, as this gets, and it depends, I suppose, also on the vintage of your investment. If you bought in 06 or 07 and then suffered some deterioration in 08 and 09, there was a serious issue with respect to performance of the portfolio. You may have investors or others complaining, putting pressure. And the SEC has responded to that by looking at expense allocation. And to what Peter had said earlier in terms of whether you're having to reduce resources. How are you allocating expenses if you manage more than one fund? Are you allocating it across funds? You have to go back to your agreements and look to see what are you allowed to allocate to the fund versus what has to be borne by the sponsor or the GP. Valuation policies, and Cameron can also speak to this very effectively, are even more focused because the total assets under management or the total value of the portfolio is largely the way you determine how you get paid, either the management fee or the carry. And then finally, the actual fee calculations themselves. It's not always straightforward. There are certain things that may come up where when you drafted the agreement, you didn't anticipate that kind of an expense. So how do you be fair to everyone in evaluating who should bear it? So these are all the things that the SEC is focusing on when they're looking at this industry and they're looking at funds, and in particular when they are concerned about sort of a systemic risk, which may take the form of presence exams, where they're looking at a newly registered advisors, for example. So that's one area that we see a lot of activity with the SEC.
And at Venable, working closely with ACG, we've put together an SEC working group for fund CFOs. So if anyone on the call is interested in helping to work on that effort, please feel free to email me, and I'll get you with the right folks. Michael did foreshadow the way in which valuation can be an important part of this process. Cameron, would you care to address that, please, for a couple of minutes? And I am mindful just that my job is to make sure that we stop promptly at 3:30.
Sure.
A question here as well that we're going to try to sneak in.
Excellent.
But go ahead, please.
Sure. I'm going to look to the elephant in the room here, the troubled company perspective here. The fact is when you have a long-term investment, but it's just not panning out, you have a non-performing investment. That's the big challenge here. How do you exit from that investment? And indeed, we've talked a little bit about that already. But there are other alternatives. We have worked with private equity groups to truly do a liquidation of a non-performing company. The fact is to some degree you have a misalignment at that point in time. When you have a non-performing company, obviously the limited partners were not expecting to be investing in a non-performing company, something that's underwater, has a negative equity value, et cetera. But the question is, what do you do with that? The general partners, they might have a little bit different risk perspective. They have the idea that, gee, we know that we can still fix this. It can still be a positive. Let's hang on to it for a while. Rather than getting a liquidation value now, let's try to get a little bit more for it in another 2 years, hoping that the economy improves, that the industry turns around, what have you. Whereas the limited partners, they might have a little bit different risk profile. They might be more interested in saying, look, let's just get out of this and see what we can get on a true dissolution process, or liquidation value, for example. And that's unfortunately part of life, is to deal with those not very successful investments. And those are always very challenging.
So there's the sales process, obviously, for challenging companies where the can has been kicked down the road, hopefully not all the way to year 15, but kicked down the road. And this economy, obviously, we have a little bit more robust scenario than we've had, at least in the not too distant past. Michael, what are you seeing in terms of the sales process, and how is that impacting this discussion?
So I think the management teams that are effective are able to utilize all of these tools to maximize returns, and it's going to vary based on the nature of the investment. It might be a private sale. It might be an auction. In some cases, you might hire a banker to help you auction a basket of assets that are in a similar class. And in some cases, the portfolio company may be eligible to do an IPO, although if it's distressed, that may not be a good candidate for that. But you want to be able to look at the whole spectrum so that you're thinking as creatively as possible to try to pick the right technique or the right process at the right time for that investment and to return value to the investors. And in addition to that, again, regular communication and disclosure about these processes, I think typically is helpful. I mean, the classic discussion here, and we've been through an extraordinary dislocation cycle where the GP looks at it and says, we intended to hold this for 5 years. The LPs are saying, look, it's deteriorating. We think you need to sell now. The GP's response to that is, yeah, but if we sell now, we're likely to get 10 cents on the dollar. And the LP's response to that is, yeah, but if we wait, we're going to get 0. So who's right in that situation? You're hoping that it's an open discussion where you're using the intelligence you have and the resources you have to come to a good result.
Outstanding. Let us close with an audience question, and it's a bit of a softball that I'll give to you, Peter. So the question is, and here I'll just read it, because it is one of these things that when you're sitting in your chair, you're happy to have struck a chord. And the question is, who might be a better proponent of independent board members on portfolio companies, the LP or the GP, and why?
In my view, it's almost always going to be the GP. The LP is, in most cases, an investor. He may be an institutional investor where he's a very, very professional investor. General partners are almost always deal makers, company managers, company builders. Their skill set is in selecting people to get jobs done, and selecting the people to be on that independent board is much more in their purview than that of the LP.
Well, thank you. Thank you to Cameron and to Peter and Michael for an informative and provocative discussion. We will send around to all of those who participated on the call a request for feedback. So if there are things that you think we could have done better, we welcome your thoughts and input. We at Venable intend to host a regular series of webinars for fund managers. This is the first in what we hope will be a long series of such webinars. So we will also seek your input for other topics that you would find of interest. So I thank you in advance for your thoughts, and again, thank our panel for your very thoughtful comments today. Good afternoon to everyone. Thank you.